Hello everybody, it's Tortoise Investing coming at you today with another video. Going to be releasing this on Monday. It's currently Saturday. But today's video is going to be top 5 dividend stocks that you can buy and hold forever. Let these compound for you. These are some stocks I think that are at pretty good deals at the moment in time. Before we jump into everything, if you're new, please hit that like and that subscribe button. Both of those things are super free and super easy to do, and I greatly appreciate it. And don't forget to leave a comment down below. Like to hear from yins. So, without further ado, if you're here just for the stocks, it's going to be United Health Group. It's going to be Johnson & Johnson, T. Rowe Price, Philip Morris, and Bank of America. Those are 5 stocks we're going to be looking over. So if you came for those, hey, there's your top 5. Thanks for dropping by. If you want to look at some more in-depth of numbers, let's get into that portion. So United Health Group, we are setting with free cash flow of 5.19%. They have more cash on hand than debt. You love to see it, love to see it. Dividend yield of 1.38%, a payout ratio of 30.6%. So good. So good. This is what I like to call a reliable stair stepper, because this looks like just a set of steps going up for the revenue, the EBITDA, the cash flow to net income, the EPS, the dividend. They were doing some share buybacks, which you'll love to see. They're still doing a little bit. And return on capital employed is above 15% and has been forever. But yeah, I like the stock a lot. If you want a health sector stock, I don't think this would be a bad choice whatsoever. Let's take a look at dividend stats. They've been increasing their dividend for the last 13 years. Take a look at dividend growth. Past 1 year, 14.2%. 3 years, 15.6%. 5 years, 17.36%. That is some very nice dividend growth. Did you ever get a 14% raise at your job? Probably not without a very big promotion. So again, really good compounder. You like to see it, very reliable. Next up, Johnson & Johnson. They got a free cash flow yield of 4.44%. They got a dividend yield 2.98%. At a payout ratio of 67%, right there in that sweet spot. Their revenue, it looks very nice. EBITDA, pretty reliably, is kind of flat-ish, which isn't terrible. Free cash flow is nice, net income's going up, and the EPS is slowly but surely rising. They do have some debt, but they got a lot of cash on hand. Their debt is $26.89 billion, and their EBITDA is $21.9 billion. Easily covers it, and they got a good bit of cash on hand too. Very nice, very nice. That dividend is one of the most reliable things you'll ever see. They've been doing some share buybacks, but very little. Their return on capital employed, again, very, very reliably above 15%. Again, like to see it. This is where things get a little crazy with Johnson & Johnson. Dividend stats, been doing dividend increases for 61 years. My goodness. It's longer than a lot of us have been alive. So you can see it's pretty reliably, like, across the board, 6%. Every year you hold this, you're going to get a 6% raise. I know a lot of jobs don't even do that. It's ridiculous in my eyes, but they don't. So again, a very, very, very strong compounder, very reliable, and it's at a great price. They have had a rough year so far because they've got some lawsuits and stuff that are going through, and it has presented a very nice buying opportunity in my eyes. And again, if you're looking for a healthcare stock, can't go wrong with United Health or Johnson & Johnson. None of this financial advice, educational and entertainment purposes only. But yeah, very nice one as well. Next up, we got T. Rowe Price. Now, if you're looking for a little bit more yield and just a little bit more risk, don't think you can go wrong with this one. It's got a free cash flow yield of 8.54%. Literally no debt, none, zip, zilch, nada. It's got a dividend yield of 4.54%, payout ratio of 70.8%, a little bit high. But I think things with T. Rowe Price, once all this chaos is out of the way, I think this will be a very nice stock for any portfolio to hold. See here. Yeah, they are down big time over the past 2 years. They went on one heck of a run too. At one point, hitting what, $223 a share, and they're down to 109. That's, I mean, if you think it can get back to its highs, why wouldn't you? Especially like if you're looking for something with a little bit more yield. Again, another really good compounder. Very similar situation. Got that stair step going, revenue going up. Of course, 2022, everything's chaos right now, so this is a little bit lower on all of these. But yeah, revenue going up, EBITDA going up, free cash flow, they got some free cash going on. Net income going up, again, except for 2022. EPS going up. They got a bunch of cash on hand. Like I said, no debt. Like to see it. They've been doing some share buybacks, not as of late, but have been in the past pretty heavily. The return on capital employed, even though it's a rough year, is 22%, like from last year. Very nice. Very reliably high, too. You like to see it. Take a look at the dividend stats here. Been increasing their dividend for 38 years. Very nice. They've been doing smaller dividend increases over the last little bit because of just it being a really rough time for this type of holding. They have increased at 1.7%, but I have a feeling that this is going to be something that's going to be fixed in the near future. If we take a look here at the dividend stats, it was going up a little bit more, like 3 to 4 cents each time, but they've had to slow things down. That's the wrong one. There we go. They've in the past they've been increasing their dividend pretty reliably, and like I said, it's just a little bit slower because stocks like this get hit a little bit harder than usual at times like this. But the dividend growth stats over the last 3 years, 16%, 5 years, 16%, 10-year, 13%. The last dividend increase was only like 1%, but again, 1.7%. Stocks like this have a rough time, especially during recessionary periods. And last year was technically a recession, and this year probably going to have another one. But after that, I do believe we're going to return to the good old stair-stepping situation with them. Next up, as you seen a while ago, Phil Morris here. This is a sin stock. It is down a good bit. It was around $100, now down to 90.75. Another good dividend holder in my eyes, a good little compounder. It's got a free cash flow yield of 6.88%, 5.28% dividend yield. The payout ratio, core a little bit high, 92%, a little bit high, I mean a whole lot of bit high. But with these sin stocks, their dividend yields are usually higher, and that's the appeal with them. And they usually have a lot of free cash flow to go with it, so they can handle those higher dividends. Revenues pretty even. EBITDA, free cash flow, they got a good little chunk on hand there. Net income's going up a little bit. EPS going up a little bit. Their debt's $34 billion. Their EBITDA is $13.2 billion. So times that by 3, and that meets the 3.0 ratio EBITDA debt that I like to personally see. It's been increasing its dividend pretty reliably, although they are small increases. A little bit is nice, especially when you got this dividend yield so high. They have not been doing share buybacks, which is okay. Return on capital employed is just redonk. This is above 30%. That's crazy. They've been increased their dividend for 14 years. And again, like I said, it's little hikes, around 3% across the board you can look at when you're dealing with Philip Morris. But again, you got that it's over 5%. So, I mean, this is a great compounder, especially, again, similar to T-Row. If you're looking for something that's a little bit higher dividend yield, don't think you can go wrong with either of these. They're very reliable in my eyes. But yeah. And last but not least, we got Bank of America down big time because of all the chaos that's been going on around banking stocks. They got a dividend yield of over 3% now, 3.17%, payout ratio 27.74%. We got a good revenue stream here, net income stream. EPS was going up. They got more cash than debt on hand. Yeah, if you're feeling risky, you can't go wrong with, if you're going to get a bank, I don't think you can go wrong with going with Bank of America. They've got a good growth rate history. Over the last 3 years, 9%, 5 years, 17.14%. I mean, like I said, if you're looking for a bank stock, you can't go wrong with Bank of America. I mean, if Warren Buffett owns it, I don't see anything wrong with it personally. A man knows what he's doing, and Bank of America makes up over 11% of his portfolio. And I can almost guarantee you that this man is buying Bank of America right now, getting dollar cost averaging down, and it's going to be higher than 11%. I can just about guarantee it. The next time that his little sale records go out, what he's bought for the quarter, you know he's buying Bank of America right now. He has held Bank of America for so long. And at the current levels, the last time you could have got in at this price was 2020. You know what was happening in 2020? We all know what was happening in 2020. But, yeah, guys, that is 5 dividend stocks. Have nice little dividend yields and some growth that I feel would be a good addition to almost any portfolio. Again, not financial advice, just educational and entertainment purposes only. But yeah, thanks for watching. If you got any questions or anything, let me know down below. And until next time, see ya.